My name is Karen Jones, and I'm happy to present the 2025 forecast. Thank you for joining us as we take an in-depth look at the current state of the housing market, key economic trends, and what they mean for the future. In this presentation, we'll be covering critical insights about inventory levels, household formations, population growth, and how these factors impact home prices and market dynamics. We'll also dive into the fundamental principles of supply and demand, explore what's driving changes in active listings, and discuss why real estate continues to be a solid investment for the long term. Whether you're a real estate professional, a homeowner, or simply someone curious about the market, this presentation is designed to provide clarity with actionable insights. The analysis is backed by accurate data, predictive modeling with proven expertise, so you can feel confident about the information you'll be hearing today. Let's get started. The information we'll be discussing is supported by data and forecasts provided by Barry Habib and his team at MBS Highway. Barry is a highly respected industry expert with over 2 decades of experience in mortgage and real estate forecasting. MBS Highway's 2024 forecasts have been remarkably accurate, further demonstrating the credibility of the data we're working with. For example, their 2024 forecast for home appreciation predicted a 4.5% to 5% increase. The actual number landed at 4.5%. This track record highlights the reliability of the insights we'll be sharing with you today. With this strong foundation of data and expertise, let's move forward into our presentation and explore what these trends mean for the housing market, the economy, and the decisions that lie ahead for all of us. Let's start with inflation and the Fed's outlook for 2025. Now, what do we expect the Fed to do with rates? Well, back in December, the Fed released their dot plot, showing where they anticipate the Fed funds rate will be. The current rate is at 4.375%, which is already down significantly from September's 2024 number of 5.375%. Of the 19 members, one expects no rate cuts whatsoever in 2025. 3 project one cut, and the majority, 10 members, anticipate 2 cuts, bringing the rate down to 3.875. A few members foresee an even lower rate, with one projecting at 3.125%. Now, MBS Highway's forecast aligns with the anticipated aggressive cuts, and they predict that the Fed funds rate will drop to 3.375%, which is about 100 basis points lower than what it is today. This is based on expectations of inflation declining and a softening labor market. The Fed itself estimates that unemployment will rise to 4.4 to 4.5%, up currently from the 4.2%. If unemployment moves to 4.6%, we could see even faster rate cuts, which would likely trigger a favorable response in the bond market and lead to lower mortgage interest rates. Historically, when the Fed lowers rates, it creates a ripple effect in the bond market. Investors will start moving money out of lower yielding money market funds and into longer-term investments like the 10-year Treasury, which offers a slightly higher yield. As more money flows into Treasuries, bond yields dropped, pulling mortgage interest rates down with them. Now, this transition does not happen immediately. Investors will wait for signals such as a weaker labor market or continued declines in inflation before moving their money. However, once this shift does begin, it could create a significant downward pressure on Treasury yields and mortgage interest rates. In summary, if the Fed implements the expected rate cuts and inflation declines as we predict, we could see a favorable environment for both the bond market and mortgage interest rates in 2025. This will be critical to watch as we move throughout the year. What exactly is inflation? Inflation is simply too many dollars chasing too few of goods. While the rate of inflation has been coming down, it's important to remember that it adds to the inflation already in place. Here's a visual representation. The red line reflects the rate of change in inflation. While it has spiked in the past, we're now seeing it trend downward. Now that's good, but it's still above zero, meaning inflation is still piling onto the consumer's financial burden. Why are people so sensitive to inflation? Because it rarely goes down. Even though the rate of increase has slowed, the cumulative effect is significant, especially after a spike like we saw recently. Consumers feel this burden every day. The Federal Reserve measures inflation through the Personal Consumption Expenditures, the PCE index, focusing specifically on core PCE, which excludes food and energy. Why exclude those? Because food and energy prices are influenced by factors outside of the Fed's control, like weather or geopolitical events. By focusing on core PCE, the Fed can target areas it has more influence over. The Fed's goal is to get the core PCE to 2%, and currently it's at 2.8%, which is why some Fed members are saying the job's not done yet. Here's why inflation impacts interest rates. Mortgage rates, for example, are tied to bonds. If you're receiving fixed payments on a bond, inflation reduces the purchasing power of those payments over time. To compensate for this erosion, higher interest rates are demanded. That's why elevated inflation keeps mortgage interest rates higher, and when inflation comes down, so do rates. Let's dive deeper into the core inflation data. A large component, about 18%, is tied to shelter, which is measured by rents, not home prices. Currently, the government data shows rents increasing year over year by 4.8%. But this figure is delayed. The data they use is often 6 months old and doesn't reflect current market conditions. For example, real-time data from CoreLogic and other sources show rents rising only by 1.7% year over year. This discrepancy suggests that the government is overstating core PCE inflation by about 0.5%. Core PCE should currently be around 2.3% without that shelter lag. You can clearly see on the monthly shelter readings in PCE that it's a downtrend. Therefore, looking ahead, the next PCE report for December 2024, which comes out at the end of this month, January 2025, and it's replacing a low number from December of 2023. So we may not see much improvement right away. But when the January 2025 report comes out at the end of February, it will replace a higher number from January 2024, giving us the potential for a more meaningful progress. This improvement would provide the bond market with a reason to rally, which would bring interest rates down. This is really positive news for the housing market and for consumers overall. What is MBS Highway's core PCE inflation prediction? Inflation will reduce from 2.8% to the 2.1, 2.2 range sometime this year. This will most likely encourage the Fed to be less restrictive and reduce the Fed funds rate, which will indirectly support mortgage interest rates to improve. Remember, inflation is the arch enemy of mortgage interest rates. As inflation improves, so will interest rates. Our next topic is the labor market, the supply and demand of employment. Let's move on. The labor market is closely monitored by both the Federal Reserve and the financial markets. A strong labor market often signals to the Fed that the economy is performing well. To make decisions, the Fed relies on data collected from various agencies, with the BLS report, the Bureau of Labor Statistics, being the most crucial one. In September of 2024, as reflected on this chart, the reported data included seasonal adjustments, which created a more optimistic view of employment compared to the unadjusted raw numbers. However, as the chart also indicates, unemployment in the labor market increased once again. While some have speculated that external factors such as the upcoming elections may have influenced how the data was presented, what's clear is that this information played a role in shaping the Fed's policy decisions. Mortgage interest rates are closely tied to the Fed's decisions, and the Fed uses many different reports to determine what they will do with the Fed funds rate. If the Fed funds rate were to decrease, it might trigger a positive reaction in the bond market, potentially leading to lower mortgage interest rates. But can we say this with absolute certainty? Not quite. It's speculative at this point. However, such a shift could influence the pricing of mortgages. Unemployment is on the rise again, but let's see why. Do you think unemployment will continue to rise? Let's break it down. The first thing we need to examine is the duration of unemployment benefits. While employers haven't been letting employees go at a rapid pace, it's clear that once individuals lose their jobs, they're staying unemployed for a longer period of time. And there are other clues that unemployment is not going to vastly correct itself. This rise in unemployment is significant and gives us important clues that we can see more of this trend in 2025. Another factor to consider is the wave of store closures we're seeing. These numbers are substantial. For example, Macy announced they're closing 65 stores. But think about it. How many people work at just one Macy's location? Multiply that across all these closures, and the impact on employment becomes much clearer. These are just the highlights. There are many more closures happening across industries. This means more people could lose their jobs, which has a direct impact on the bond market and the Federal Reserve's decisions moving forward. Let's look at the other side, hirings and job openings. One key report to watch is the Job Openings and Labor Turnover Survey, or the JOLTS report. It's a closely followed indicator, and as you can see, there's been a clear decline in the number of job openings. While there are some spikes here and there, the overall trend is heading lower. A year ago, there were 8.8 million job openings, but now that number has dropped to 7.7 million. But there's something important to note here, and this may be influencing the numbers in this report. Many job postings are listed in multiple states due to the rise of remote workers. This means the same job could be counted several times, inflating the numbers. Realistically, perhaps the actual number of job openings is likely below 7 million, maybe even closer to 6 million due to the way jobs are being posted. What is the MBS Highways forecast for the labor market? Their expectation is that unemployment rates will rise from 4.2 to around 4.5 or even 4.6%. This increase is significant and could influence the Federal Reserve to act more favorably, which bodes well for mortgage rates. And talk a little bit about mortgage interest rates. When paying a mortgage, you want the lowest interest rate, but for investments, you aim for the highest return. Many investors turn to money markets, which last year offered strong yields at 5.5%. However, since the rates paid on money market funds are tied to the Fed funds rates, as the Fed reduces, interest rates are also reduced, and many have dropped closer to the 4.5% range. At a 4.5% rate of return, money markets provide a decent return for investors with almost no risk. Now, if that investor wanted a slightly better return, they might consider a 10-year treasury, which may yield around 4.6%. Treasuries, however, carries a higher risk to investors since its value fluctuates with interest rate changes. Because the added benefit is minimal, most investors have stayed in money market funds. Once the Fed starts lowering interest rates, by the way, and that could be done by 0.5% to 1%, as they've hinted at, money market yields could drop down to 3.5% to 4%. At this point in time, smart investors may shift money from money markets into 10-year treasuries, locking in those higher yields before further rate cuts. This shift would create demand for bonds, pushing the 10-year treasury yields lower. And since mortgage rates often move with treasury yields, we'll likely see mortgage rates drop too, resulting in favorable environment for borrowers. So where could the 10-year treasury yields go? Back in the fall, they ranged from about 3.6% to 3.7%. Could we revisit those levels? Absolutely, especially with weaker job numbers or better inflation data. Now let's talk about how this impacts mortgage interest rates. While the 10-year treasuries and mortgage rates generally move together, they're not perfectly aligned. There's something called the spread, the difference between the 10-year treasury yield and the 30-year fixed mortgage rate. Historically, over the past 30 years, this spread has been in the range of 1.6 to 2%. For example, if the 10-year treasury yield is at 5%, mortgage rates would typically be around 6.6% to 7%. However, during financial disruptions, like the Great Financial Crisis or COVID, the spreads can widen. In October of 2023, the spread hit over 3%, with the 10-year treasury at 5% and mortgage interest rates spiking to 8%. Since then, the spread has improved to around 2.5%, but still above normal, but trending down. If this trend continues and the spread narrows further, mortgage rates could decline faster than treasury yields, creating a more favorable environment for borrowers. Even a slight improvement in the spread means mortgage rates could come down faster than treasury yields. Let's break it down with some math. If the 10-year treasury yield drops to 3.6% and the current spread of 2.5% narrows to 2.25%, we can see a 30-year fixed rate mortgage rate land in the range of 5.85% to 6%. If the treasury yield moves slightly higher to 3.7, mortgage interest rates would probably hover around 6% to 6.125%. This range is very realistic, and what's exciting is that we know that the housing market responds extremely well when mortgage rates reach the 6% range. Let's dive into what this can mean for buyers, sellers, and the overall market. This brings us to our forecast for the housing market, and this is an area I feel really confident about. For over a decade, we've heard repeated predictions of a housing market crash. But what has actually happened? The market has consistently gone up. At its core, the housing market is governed by the same principles that drive all economics: supply and demand. Let's break this down and take a closer look at what's really happening and what we can expect moving forward. There are 136 million households in the United States. 45 million of them are rented and 91 million are owned. Let's talk about equity, a powerful tool in the housing market. For renters, there is no equity, zero. They're not homeowners. But for homeowners, the story is completely different. Homeowners collectively hold an astounding $37 trillion in real estate, averaging $407,000 in equity per household. Even more impressive, 35 million homes, about 40%, are owned free and clear with no mortgage. These properties represent $20 trillion in equity. Why is this important? Because these homeowners face no affordability or interest rate concerns, making them potential movers in the real estate market without the hurdles of higher borrowing costs. For many, they're selling their home and using the proceeds to purchase a new home in cash. For the remaining 56 million households with mortgages, there is still significant equity. $17 trillion in total, averaging $311,000 per household. This represents opportunities for cash out refinances, debt consolidations, move up purchases, or even using equity to build a real estate portfolio with rental properties. Let's turn to demographics because demographics is destiny, quote unquote from Barry Habib. Understanding population trends help us predict the future of the housing market. Using these insights predictively. Over the next decade, the growth of millennial and Gen Z homeownership is likely to drive a healthy housing market. Let's dive deeper in some of the modeling that MBS Highway has completed to explore these future trends. Let's start with the millennials. There are 73 million millennials with a median age of 35, and their current homeownership rate is at 45%. But let's focus on a smaller group, those millennials aged 28 to 33. This subset includes about 40 million people with a median age of 30, and their current homeownership rate is 33%. So what happens over the next 10 years? Historically, as millennials age, their home ownership rate increases significantly. For this group, MBS Highway forecasts their home ownership rate will grow from 33% to 55%. That's a 22% increase, equating to an additional 8.5 million homeowners. Now, let's look at Gen Z. There are 69 million Gen Zers with a median age of 20, and their current homeownership rate is only 8%. But as they age, they're likely to follow a similar path as the millennials. Over the next decade, MBS Highway predicts that their homeownership rate will rise from 8% to 33%, adding another 17 million homeowners. When you combine these two groups, millennials and Gen Z are poised to generate 25 to 26 million new homeowners over the next 10 years. Accounting for some overlap and changes among boomers and Gen Xers, the experts estimate the net new households is between 18 and 19 million. This strong demand underscores why housing remains a solid long-term investment. Let's take a closer look at how these demographic trends will continue to shape the market. Let's talk about active listings, a key indicator in the housing market that often gets misunderstood. There has been a lot of noise about active listings soaring, but let's look at the facts. It's true, active listings have risen 27% year over year. But this increase is concentrated in areas with high population growth. Even with this rise, inventory levels are starting to level off as we see at the top of the curve. Is a 27% gain in inventory a bad thing? Does that mean we have too much supply and prices will crash? Not when you look at the bigger picture. Pre-pandemic active listings ranged between 1.1 and 1.3 million homes. Today, we're still under 1 million active listings, which is 21% lower than in 2018. Meanwhile, the US population has grown by 12 million people since 2018, which only adds to housing demand. Inventory growth is likely to slow further, while strong population growth and current interest rates will continue driving demand. Let's dig deeper. Household formations in the United States remains steady at 1.9 million per year, a figure that's consistent with historical trends. Here's the challenge. While we need 1.9 million homes built annually, we're only building 1.3 million. Historically, the United States built closer to 1.4 to 1.5 million homes per year. So this underbuilding trend is significant. When you have too much demand and too little supply, prices rise. This is the fundamental economic principle. As this supply-demand imbalance persists, inflation in home prices is very likely. MBS's highways forecast for home appreciation in 2025, a 4.1% appreciation year-over-year increase, which means for that $500,000 home that a family acquired, they now have another $20,500 in equity. Is owning a home a good investment? The numbers tell us definitely yes. Here's a summary of the 2025 MBS highway forecasts. Home prices, they'll appreciate by 4 to 4.5% year over year. Core PCE inflation should drop to 2.1 to 2.2%. The unemployment rate to increase to 4.5 to even 4.6%. The Fed funds rate to drop to 3.25 to 3.5%. And finally, mortgage interest rates to decline to 5.75 to 6%. Thank you for joining me today. It's truly an honor to support families on their journey to homeownership, creating a strong foundation for lasting financial security. I'm passionate about homeownership, and I'm proud to collaborate with some of the finest real estate professionals who are dedicated to helping families take that exciting step. So buying a home is all about strategy. When you're ready to get yours, I'm here to help. So give me a call today.